All right, good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for April 5th, 2014. Starting off with the market classification, we are in bullish normal conditions. Looking at the long-term market posture using weekly RSI 14, we are in neutral, at the high end of neutral with a score of 65 out of 100. Looking at the short-term posture, the 10-day trade location using the 10-day NDX, we're in the slightly below the midpoint of neutral with a score of 43 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is yellow bullish at 7.03%, meaning we have a 5% cushion between price and sideways markets. The slope of the 50-day moving average at 0.31 is yellow neutral. ADX is also neutral in terms of strength of trend over the last 14 days at 19.2. Not surprising given the choppy nature of the last couple weeks. Relative volatility is in the range of normal here at 1.06, so it got slightly less volatile this week. The risk index is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX. The threshold is 1.0 between risk off and risk on. That current reading is at 1.04, which favors a risk on posture, meaning that riskier assets are favored to be held. If we take that score of 1.04 for the risk index and then compare that to the last 5,000 trading days, and find the z-score, we find then that the risk z is 0.42. And this is a time series of that indicator showing relative volatility swings. And you can see it bottomed out here at minus 0.5 and has now climbed to 0.42. So the volatility posture of the market for the long side is improving. And this should lead us to looking at things like XIV on swing trades and as intraday trading candidates. This week, the blended monthly rebalancing occurred, and these are the current holdings for the next month. ETF 13 is holding real estate treasuries in the U.S. mid-caps. ETF 22 is holding utilities, healthcare, and U.S. real estate. And ETF 32 is holding the agricultural futures, DBA, utilities, and healthcare. And then under the current leaders, these are the ones that are at the top of the stack for each of those respective ETF populations and the Dow 30. Microsoft continues to be on a tear here. We'll take a look at Microsoft when we get to charts of interest. In the ETF2 model, the theoretical exposure improved to 80% this week, and the model portfolio itself will be at 80% exposed. There was one sell this week, a stop was hit, and then one is being sold by rule, and then there's two buys in Italy and Indonesia. Quick look here at the blended monthly rebalancing tables. ETF 13, you can see, is mostly on buy signals except for technology, which is close, and then Japan. And then in the ETF 32, almost everything again is on a buy signal, with the exception again of technology, Japan, China, and emerging Europe. But you can see this this return here in DBA, the agriculture signal. That's one that we've been tracking through the swing trades in the chat room, looking at the symbol CORN, C-O-R-N, as well as DBA. It's just interesting to note, again, there's almost a 25% difference in performance over the last 3 months between the leading candidate here, agriculture DBA at plus 16.5, and then emerging Europe GUR, which is at minus 0.8%, or minus 8%, excuse me. At the top of the stack for the ETF Max, using this technique here, I'll let that come up on your screen. There we go. Still being led by the coffee, agriculture, solar, Egypt, long commodity fund here, DPU. India and Indonesia are prominent among the top 50. So you got India small cap, you have Gulf states and Middle East dividends, Indonesia investable market, EIDO. That's when we're buying an ETF too. Another India, and here's Italy at EWI in the 22nd position. Lots of precious metals I'm seeing in there. There's gold miners, there's nickel, there's base metals. So a shift to tangible assets in the top 50 is evident here between metals, precious metals, grains. All right, moving on. Next up is the market health check. Okay. All right, so our vertical blue lines represent 10, 20, and 30 days worth of look back. The horizontal red lines are reflecting support levels that have held in the past and which, if violated, would become price targets on the downside. Let me just expand that a little bit so you can see. Good. The dark blue shaded area in the middle is the 30-period Bollinger Band plus or minus 1. That's the river. The lighter blue shaded area is the 30-period Bollinger Band plus or minus 2. That's we call that the floodplain. The reddish ribbon running through the river is the dragon. That's the 10-period Bollinger Band plus or minus a half, and that acts as a front runner for the changes in direction of the river, and gives us some indications when we're at extreme readings on the channel trades. Channel trades we're thinking of as the distance between the floodplains, edges of the floodplain, and the dragon goes from side to side and gives some insights into when those channel moves are at extremes. We have 3 regression channels marked off here. The short term is the 10-period. That's this blue channel, with the center line being the 10-period regression line, and then the outer blue lines are the channel formed by the maximum excursion from the regression line during the look-back period. And you can see right now that price has pulled back all the way to the southern boundary of that of the 10-period regression channel, still within the channel, which is sloping up, but looking to find support here. And this is, I think, a pretty important support level here at 186, because what you have is the confluence or the intersection of the Bollinger Band mean, the red line, the bottom support level from the 10-period channel. It's right back to the 90-period regression line here in the green, and at the south side of the dragon, which is providing support for this upward move. So in my view, 186 is a pretty important support level. The next one being about 184.5, which would be the support level of the 30-period regression channel. That's the third black line. You can see 30-period regression channel, the regression line is the center black line, and then the channel formed by the maximum excursion. And so this support level at 184.5 is really important in my view. It's the almost the 20-period low. It's the southern end of the river. It's the support level from the 30-period regression channel. And so for this upward trending market to resume, we would really want to see it stay north of 184.5. You can see on ADX that the market really is not trending, although the bulls are in charge with ADX underneath 20. That's indicative of a choppy market that is slightly trending higher. All three regression channels trending higher, although the 30 is starting to weaken with respect to the 90. And this move on Friday, that harsh sell-off going into the close, really puts the 10-period channel at risk. However, what we would say is this is typical behavior in a long-term bull, and this should be seen as a buy-on-dip opportunity until proven otherwise. And if we find support above 186, that would be great. If we see it above 184.5, that would also be great from a channel trade perspective, because you have more room to run. I am showing the purple line here as the price target. That was the last swing high on the previous cycle, and so we would like to see price get back above 188 and then above 190 to really have no worries about this long-term bull. But I'm still showing 188 as an important price level to get through, because otherwise people will start seeing this move to 189.5 from Friday as sort of a the head of a head and shoulders formation and a false breakout. So that's why this is this purple line, I think, at 188 is really important. We want to see price get back above that and then above 190 for the bull to continue. This sine wave looking thin black line is the time series on the slope of the 30-period regression line. So you can essentially see that as the time series of the slope of this central black line here. And so what we have, we've seen it in the last 3 months go from this average reading about 0.22 down as low as minus 2.75, and then where it bottomed out, and then the slope started improving. It got positive here at the end of February when it crosses this dotted line in the middle, and then gets as high as 0.45, and then has pulled back towards the flat line. Now, what's of interest here is this, I'm showing in this blue circle the regression line slope trying to get better, and the Monday through Thursday price moves, which took the market from 184 to 190, a 3% move, was enough to halt the decay of that slope and start turning it around. But we're now sort of at a turning point based on Friday's action, that it started to nose over to the downside once more. This blue circle here is marking off the zero line. This dotted line is where the slope of the 30 goes negative, and that would be a bad sign for the market if the 30-period regression channel rolls over. Then we would see the intermediate term really topping out. The last time it did that was back here in January. It only got as high as 0.225 and then rolled over and then gave us a move from 185 down to 173. So that was about a 6% sell-off. And so that's really kind of the magnitude of the move to the downside that we would be concerned with here. Now, to be fair, that set the conditions for a really nice swing trade move in here. So we're watching what's happening right now at this critical turning point, in my view. There's strong support at 186, support at 184.5, and then final support down here around 182. If that fails, then that's really a 40-day low, and then we'd be looking at price coming down as far as the 90-period channel down around 176, and then that would put us into sideways conditions if it were to go that far. But we haven't had a 10% correction in this market in a long while, and so that potential is always there. A 10% sell-off from the swing high at 190 would be 19 points off of that, which would be like 171. So that puts this move down to the 200-period moving average really as what a 10% correction would look like. So that's on our mind. So these are the support levels: 186, 184.5, 182, 180, 177. and those are price targets on the way down should these price levels collapse. One more thing to look at. We'll take a look at some of the swing indicators here. We'll shift down a little bit. What we'll notice here is that the jaws of PPO, percent price oscillator, have closed right now. So that Friday's move actually does put that beginning of that move at risk. If we go back on PPO a little bit to the last time we had a nice bullish move was a move here from about 177 up to 188, and during that time PPO, price percent oscillator, opened to the upside and made this nice move all the way to really to the swing high when the jaws closed, and then jaws opened to the downside. And during this choppy market condition in here, PPO was open to the downside and warning about that. It closed here on this move Monday and Tuesday. That was enough to close the jaws and then open it to the upside. And things look good for a good retest to 188. It actually broke through for a couple days, but then Friday's move closes that. So we're kind of choppy right now. We're just coming out of overbought conditions using Williams percent R, and we haven't quite reached oversold conditions yet for the normal swing trade to occur. But the channeling and the overreaction signals would be firing if we get one more day of selling, and we get a close down here around 185-ish, which would not be unusual. We would see those swing trade patterns firing. In fact, we did see that in the Russell and IWM. So we're in a market that is in normal breathing conditions, and we would expect that normal behavior would be to find support at 186. We're failing that 184.5, and certainly at 182. And now these all become something like buying areas for buy on dip opportunities. So that certainly the upside is there, and then the downside we've got marked off. I'm not going to be negatively biased until it gets into this reddish area, and that would be south of 182. So between price right now at 186 and 182, in my view, I'm in what I call the yellow zone conceptually. And so while price is here between 188 and 182, I'm looking at these, looking to take my intraday movements based off of the direction of SPY, and I'm ready to go in either direction. And the reason is that while I can make some money on the upside when we have strong market moves like Monday through Thursday, there's also this phenomenon of big adverse moves in a bull market, like these one-day big red candles. Those are almost all signal and no noise. And so being open to different directional moves intraday, but only holding that for intraday, is my technique for the yellow zone. If we're to get back above 188, I would definitely have a bias for the long side, and certainly if we get above 190. Now, I don't have a default short side bias until price were to go below 182, and that's what I'm trying to indicate by the green, yellow, and red of how I'm using the swing trade market condition to shape my techniques and preferences for the intraday trades based on what color zone. So hopefully that's clear. Okay, moving on. Oop. Okay, so this is the ETF2 model, the regional report, the 10 regions of the world market model. And based on the moving average filter, we have 8 out of 10 are on a buy signal, 2 are on cash signals, and that's U.S. technology and Japan. So that would leave us in the allocation strategy at an 80-20 relative health, and that's an improvement over last week, which was 70-30. Market conditions will normal. The S&P is better than the global, so the S&P at 50 under the strength column. The S&P is at 50, Europe is at 50, but EFA, which is the globals, is at 48. So right now the U.S. is favored compared to the globals. And then inside the U.S. indices, the strength is in SPY at 50, then mid caps at 49, then technology at 48, and then small caps at 47. So that's the, if we were to rack and stack the U.S. indexes, that's how that lineup is. The two strongest sectors right now remain the European large caps at 50, IEV, and then the U.S. large caps, SPY, at 50. And then the two weakest sectors are emerging markets at 46 and Japan at 41. Inside the U.S. sector spiders, strength right now in utilities and in healthcare, with weakness in consumer discretionary. Looking out now wider at the world market model. What we have is the U.S. All above average except for the Dow, and Indonesia, Vietnam in the green, all of Europe slightly above average. So really little to no change from last week. ETF top 30, and what we're looking at here, solar, natural gas, Indonesia, lots of India, basically the same kind of patterns that we saw emerging out of the blended monthly rebalancing. What I like to look at here are those that are white on consistency, which is a 10-week moving average of strength, and green on strength. So I get very interested when I see new strength moving to the top, like Indonesia, EIDO, which is white on consistency and green on strength. That represents a relative newcomer to the top of the stack, whereas solar and natural gas are green and green, so they've been there for a while. So when we look for emerging strength or newly found strength, green and then white is the indicator. So we would look at Indonesia, then India, another Indonesia, which is IDX, then agriculture, India Nifty 50, India earnings fund. So that should have our attention if we want to play like some macroeconomic trends on a swing trade basis. We ought to be looking at India and Indonesia right now. Here's two more from India, the MSCI India Index, and then the India portfolio. PIN, which is, that trades 1 million shares a day. So that gives you some room to work with it here. I still like DFE from ETF2. That's greens all the way across the board. That's a solid, broad asset class that pays some dividends and is relatively stable. Here's some more new ones: the utilities, the Frontier 100, the Rogers International Commodity Agricultural ETN, RJA, and the Vanguard Utility. So that's how I use this report, is to just see where are the strength leaders and who are the emerging strength sectors. Inside the Dow 30, greens across the board for Merck, Caterpillar, and Microsoft near the top. Now, what I like, this would indicate Microsoft should have our attention because it's green on strength and white on consistency, and is now above that key price level of 40. And then United Health is green and white. Okay, moving on. Now, the ETF liquidity, this is just showing the top 30 ETFs based on daily dollar volume, which of the last 30 days, and gives you their relative ATR percentages, so you can see what are liquid and also volatile enough to trade. So the VIX in position number 5, for example, is trading $1.5 billion a day on average and has an ATR percentage of 3.25. Just interesting to note once more how the small caps are really dominating the Qs as a trading vehicle. They're now 50% more liquid on average than the Qs. So the Russell definitely got the traders' interest right now. Also, that there's apparently been some trading activity out here in the mid caps. MDY is moving up the stack, and at 1.33 is also reasonably volatile and liquid. Shifting to the daily, we've got in the middle here some channeling signals here for the Qs and for the Russell 2000. You can see the volatility spike here based on ATR percentage is right at the high end of normal. The 10-day max pain candidates, Visa, Microsoft, Nike, Disney, and Goldman Sachs. Now, this should be very interesting for us now to look at Microsoft. It's one of the Dow strength leaders, and yet is showing up on the 10-day max pain. So anytime you get an high relative strength that is in a pullback shorter term, that gives you the an opportunity to look at like a poor man's triple screen or a buy on dip opportunity, and Disney has been one of those strong ones too. So we're going to look at Microsoft and Disney for sure. Channeling signals on the small caps, the Qs, and then XLK is the technology sector spider. And then among the large caps, Visa, Nike, American Express, and Home Depot. We have 551W signals in agriculture and Coke. And then in the auto framer, these symbols here all test out better than 2 to 1 based on trade location and the mechanical setup. So the globals, Japan, Asia less Japan, coal, gold, and oil. So some commodity plays in the works. Quick look at the tactical summary for the Dow. We have a couple here at the top. Visa and Nike are channeling signals. They're both single digits on RSI2, so that's a good thing. And Microsoft was a big percent loser on Friday. You can see it lost 2.8%, and it came in at a 9 on the RSI2, and is a max pain. So that looks attractive. We'll definitely look at Microsoft here in a minute. Looking at ETF2, there's two that fired on the RSI2, and that is technology and technology. So that should also give us reason to look at Microsoft. So there's a logic chain setting up nicely for Monday's trade. The small caps and the Qs lost 2.7 and 2.3% respectively on Friday, and that was enough to make them channeling, and it pushed the technology into the RSI2 value of 10. And then XLK comes in at a 9. Treasuries at 2.2 on the auto framer, and the VIX at 2.3. So we have some trading opportunities. Here's DBA, which gives us a triple screen pattern as well. So we'll take a look at DBA. From the auto framer, we have the Euro ETF FXE comes in at 2.83%. Again, that's the index. This tells you the source based on the different symbol sets that I track. So it's a 5. That means it's coming out of the ETF 200, meaning that it's liquid enough to trade, and it comes in at 2.83% reward to risk based on using the range risk value of about 54 cents. Compared to the 10-day high at 137.04. The mechanical entry on that would be at 135.51, and if you used a 54-cent stop with your target of 137.04, that would give you a 2.83 to 1 reward to risk. That's how you read this. Otherwise, we have the VIX, the Internet Index, Treasuries, and the Biotech Spider XBI, all framing out well on using this technique. Now, in the range or in the risk calculations, there are 3 different risk levels that we test for. The minimum ATR risk, which is a quarter of an ATR. The maximum ATR risk, which I've set for a value of 1 full ATR. And then the range risk, which is the previous day's range plus a buffer of 10 cents, 5 cents on the upside, 5 cents on the downside. And then my risk reflects the center of those risk levels. So if we look at the euro currency, a quarter of an ATR is 16 cents, a full ATR is 65 cents. The range risk happens to be 54 cents, so that's the one that is selected and reported in my risk, and then that's what's used to compute the reward to risk ratio. So by the same token, the VIX had a range risk of $2.21, whereas the full ATR is 1.36, so it chooses 1.36 as the intermediate value for computing reward to risk ratios. What that tells you right there is that Friday's move of $2.10 was almost 2 full ATRs intraday, on an intraday move. Okay, enough of that. Let's shift to charts of interest. All right, so the first one we'll just take a quick look at is the market itself, SPY. And let me shift to the daily on this one first. All right, so if we were to mark off just a quick trading channel here. Let's see, pen color. All right, so this is what I'm seeing. This is that support at 184.5 that we talked about from the health check, and then this 189. The top of the dragon right here is kind of crucial. This was the false breakout here around going up to 189.5, 189.75, which is where the that's the all-time swing high right there. So what we have is, with price down in this area at 186.25-ish, this is really a buying zone, and there's 2 units of reward to the upside. So here's reward 1 with the price at about 188, and then reward 2 around 189.5. There's your 2 units of reward, and then here's your unit of risk in the bottom third of this channel. So if price were to hold at 184.5, we're not entitled to be surprised by that, because that's the bottom of the river, and the last 2 times that it got to this level, it held and responded with two moves intraday that were very tradable. So that's sort of the expectation when the market's at a top like this. If we wanted to refine that a little bit, and then go away from the daily, and my next dial down would be at the 2-hour. I like 2-hour charts for swing trading purposes. You get very smooth and orderly moves, like this move here, which went from an RLCO pattern outside the river in this blue circle to an RLCO pattern outside the river at that second move. So that's the defined move. And then I want you to notice how quickly the dragon shows the way, and then when price violates, that price ribbon violates the dragon to the downside, it tells you that move is over. Well, we also knew that because of the RLCO outside the river. That's the move. So now we have price coming down here to the south side of the river around 185.5. Notice the strong support here around 184.5. That's really the drop dead support level that represents the low end of the last 10 days. So that price level's got to hold. So that now creates a buyable moment down in this region that if price holds like it has in the last two times, then the next expected move is a return to test the upside of the channel up in here. So that's the move we would expect. But failure below 184 now gets it out into beyond the floodplain, and now we're looking to the downside. You can tell there's increasing volatility by looking at the expansion in the Bollinger Band channels and that the width of the river is getting wider. And so that's the frame that we have for the market. Very tradable, and we're approaching buy on dip opportunities for swing traders. All right, so let's take a look at some of those other symbols of interest. Let's try Microsoft in here. So now we're looking at the 2-hour swing chart on Microsoft. The last move was support down here at 39.5, which is where we can still treat that as a support level. Now we're in the buying zone down here in the floodplain. We had 3 lower lows on the 2-hour charts, and so what we'd be looking for is a nice orderly open around this area. It doesn't make a new low and then starts moving back this way, and then our targets would be 40.60, and then 41.30, and then 42. And we'd be happy here if it could just get up and retest 41.40. This gives us our rewards, and then this would be our risk down here. So that's sort of a channeling trade setup, by the numbers. If we step back a little bit and look at the daily chart, this is the daily on Microsoft now. And this is a place where we would expect it for that channel to continue to go. This is the area where it should be finding support along the support line here. It's still above the fair value based on the VWAP here and the Bollinger Band mean. So this support level at 39, and we're at 39.87 on the price. So if you call that $1, say, is this tradable? Yeah. Can you see $2 to the upside? Certainly. 42 is sort of the target. And there's your $2 on the upside and 1 on the downside inside this trade frame. So Microsoft is well within the reasonable channel for buying strength on dips. Okay, let's take a look at DBA, the agriculture now. So here we are on the daily. Now this is starting to look a little downwardish here on the daily. This was that strong upward move on the dailies. And then the concern here is this is almost a lower low. So 27.90 really has to support. Now, the good news is that we had a positive close and a positive intraday on Friday. It was up almost 1%, whereas the rest of the market, if you look over here, DBA was up 8%, while the market itself was sharply down. So if it can get above about 28.40 and continue, we would expect to see 28.80. And then 29. Remember, this is tied to the commodity contract, so it's never going to run away completely. But you can get some of these orderly moves, like here was the move from 26.5 to 29, almost to 10. That's a 10% move in the value of the underlying contract there. So this would, if the hypothesis would be that this is a support level at 27.90, and we have 2-to-1 to the upside, and then if it takes out 28.80, then you could see another move like we saw here. So DBA looks to be interesting. We want to look at oil. And I want to back this out just a little bit so we can get a wider context. All right, this looks promising for oil on the daily. What we had was we had a high back in January and then a new swing high here. We had a swing low at 32.50 and a higher low at 35, and then another higher low here at 36, and we're getting ready to test this one. So we really have 3 higher lows that are being connected, and so the channel is looking like this. So this was a very favorable Thursday and Friday. If we can get above 36.5, then we should be able to see 37.50 pretty easily. That's the next move in oil. But if it fails here at 36.5, it comes down and tests. Then if it gets below 35, you have an auto short right there, because this was a lot of volume providing that support. So if that fails, you're now outside of the floodplain, and then the target would be down here at 32.5. So that's oil. We want to look at, we'll take a look at gold. This is a nice pullback on after a nice swing trade move. So we have this low here around 114.5, and then had the nice move here to 132. So that's a 10% gain. And out of this sideways quiet channel, and I want you to notice how the Bollinger Band mean sets the tone. But now we've had the 30-period regression line cross the Bollinger Band mean, and we've moved from edge of the floodplain to the edge of the floodplain, and then 2 days in a row of increased price activity. And so this is essentially a Z trade, pattern 7 in the RLCO, because we had price outside of the floodplain, that's a Z of -2, and then buy it not later than price entering the river with a stop down here, and then with 1 and then 2 units of risk to the upside. So this is sort of a buying strength on a dip. That's the move that we're looking for right there. That's a pattern 7 RLCO. Let's take a look at Nike. That was one of our RSI2 symbols, if memory serves. Nike also in a nice pullback. This is reminiscent of that the Microsoft pattern. So some price stabilization here, making a higher low. The real concern on that one, though, is that when you look closely at Friday's price action, it actually broke this previous swing low here. So Nike may have cracked. So at the sign of additional weakness, Nike to the downside. But if it holds here, I'd be looking at buying not later than, I'd like to buy around 74.5 with the idea of the Bollinger Band mean, far side of the river, and then far side of the floodplain being the support level. But the far side of the river is certainly within reach. There's a lot of volume that was traded in here that you'd have to get through. So a reasonable target here is 79.25 to the upside, and again, and that's about $5 on the upside. So if you can risk 2 in order to gain 5. If we see some favorable price action here, buying not later than 75, well, that's a pretty good swing trade. You can see on this that that we are approaching RLCO territory in here, because the 10 period came down and now is getting ready to cross the regression line, the 30 period regression line here outside the river. So that's going to be pattern number 1. Now price is down here, so am I in a hurry to buy this? No, I just want to see, I would like to see price open up somewhere in this region and then take out, let's call it 75. You can almost use that little dot from the parabolic as your not later than buy moment. So if we can buy it somewhere in this cluster on strength, what we'd really like to see is the market moving up, Nike moving faster, and then Nike would be the preferred play, because then you could you're targeting the Bollinger Band mean and the far side of the river. Okay, so that's we've been going at it about 45 minutes. That's all the charts that I had planned to look at. If there's any that you'd like to see before we call it a day, give me some symbols and we could take a quick look. But if not, I don't see any in the question list, so we'll call it there, and I'll get this recorded and uploaded to YouTube for you to replay later. So thanks for your kind attention, guys. Keep your risk measured and your powder dry, and we'll see you in the chat room. I should note that we just created or recreated the swing trade room in the chat room, and we're going to try to get some more activity in there. If you're interested in the swing trades, and I spent more time today, we're looking at swing trade frames. We'll try to start showing more of those kinds of charts in that room. It's kind of easy to get caught up in the day trade activity in the primary mastermind room. So we'll try to put trade frames and trade management going on for the swing trades in that other room so it doesn't get overwhelmed. If you want to improve your swing trading practice, the single best thing that you can do is post your trade frames in there showing your 2-to-1 reward to risk ratios and the price levels that you're looking at buying and targeting, and you'll get, I guarantee you'll get feedback from the folks in the room, and then that will cause you to do your best work, and you'll get good feedback, and then you can comment on the trade frames of others, and that will be a tremendous way for you to work on your trading practice at a deliberate speed using the swing trades. So take good care, and we'll see you in the chat room, and let's be safe out there.